Guys, thank you for being here. I know it's been a struggle for many of you, so really do appreciate your attendance. And for the guys who are already invested in the Carillion range or any other multi-asset products from Old Mutual, thank you for your continued support. And if you're not, then maybe you like something afterwards. So today what we'll do is I'll just go through very quickly kind of how we're constructed as a team and what we do day to day. Then we'll go over one key thing that we do, which is a behavioral bias that we seek to avoid for long-term investing. We'll then have a quick look at kind of where we are with markets and how we're positioned. And then I want to share with you something that I think is very useful for investing, which is something that can provide you with what we call downside defense when you've got markets that are falling. So we actually have a lot of history, so we've actually been born out of the old Scandi unit. So we are actually one of the teams that have got the edge in kind of the multi-manager approach. There's 7 portfolio managers. I'm one of the guys that is in those icons. Like we said, we run about 16.5 billion of assets. We focus on running proprietary tools rather than buying anything off the shelf because we believe that's the best way to generate long-term alpha. We have a bunch of global partners that we lean on, and really the global partners is linked to access to investment professionals. And the reason why global partners is really important is because it allows us to call up the guys at PIMCO, the guys at Goldman Sachs Asset Management, and actually have a conversation over the phone straight away about markets and what we're thinking. But really the key thing is it's not just me. There's 25 other people sitting behind here working on how to look after your assets. So how we're organized, we have the PM team. The key thing about the PM team is everybody is hyper specialized. So Anthony Gillam is head of desk. Paul Craig, many of you will know, who is actually the lead PM on Carillion. He's a superstar on investment trusts. Lee Freeman Shaw is actually the author of a book called The Art of Execution. He's focused on equities. Sasha Chorley's a bit of an all-rounder, but he's really focused on asset allocation. Stuart Clark as well is an asset allocation guru. Rasmus looks after alternatives, and I look after fixed income and derivatives. And the way the units are divided up is we have this fund research team, and their entire role is to go around the world finding best-of-breed managers. That is it. That is all they do. They go around the world, they talk to managers, they try and find new talent as well, and they come back to us and they say, we've got a good idea for you, or we think this manager's not so good, you should think about having a change. We have a direct investment team, so we don't just buy funds, we also have mandates with other managers. We also go out and buy bonds directly ourselves, we go out and buy equities ourselves, and we do options and derivatives overlays ourselves. We have something called a relative value team. This is something that myself and Sasha have built out over the last few years. And this is something relatively new, and this is what we think is going to become more and more focused over the next few years. What we're trying to do is provide consistent returns without having directionality with markets. And the quant team is really important. These guys underpin absolutely everything that we do. So if you imagine something like Carillion Moderate has 77 fund holdings, how do you keep track of actually what do I hold? How is this portfolio moving around? What we do every day, we have a feed from every single one of our managers on a live basis. We know how much exposure we have to oil, how much exposure we have to sterling, how much exposure we have to the 2-year bond in the US, how much exposure have we got to emerging assets, how much exposure have we got to developed assets, and there's a whole plethora of stuff that goes on behind the scenes on that side. That's really just a quick intro into the team. But this is what everybody's focused on at the moment, I think. So a quick show of hands, who feels like this about markets at the moment? Who's bearish? One. Okay, that's interesting. Who's feeling quite bullish on markets at the moment? That's interesting, okay. Well, I can tell you what, both are actually dangerous. You shouldn't really be in either camp. So if you were this guy last year, you would have lost out in 22% return from the S&P 500. If you're over here in the 10 days from the 26th of January, if you're in high beta S&P 500, you would have lost 12% in just 10 days. So actually both of these people are dangerous. So you can't really sit in either camp. And the reason why is because it forces you, if you end up becoming a bull or a bear, it forces you to buy up here, and then sell up here, and then buy up here, and then sell up here. And then all this time, your capital is going down, 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 down. And you see that a lot, actually. You see that this is one of the pillars that we basically avoid, actually. So this is what not to do with investing. And it's easy to see why, though, why people do that. Because you look at headlines, and anywhere you look, you're like, oh, central banks are taking away stimulus. What's going on with China growth? There's this guy over in Russia. What's he up to? Is he adding nuclear arsenal? Is he about to do something? What's going on with Brexit? What's going on with the oil price? What's that guy in the White House doing? And so you're bombarded with all this shock. But actually, ultimately, it doesn't really matter. It gives you a little bit of short-term volatility in markets, but none of this really matters for long-term valuation until you have a structural shift. So what we're focused on right now, these are pretty much the key things that we're focused on at the moment. So global growth, yes, 2017 was absolutely fantastic. It was one of the best years for global growth. Everything was synchronized. Is it looking like that this year? Probably not. It's probably looking a little bit asynchronous. Reduction in stimulus. We know the Federal Reserve in the US is about to withdraw some of its stimulus measures. So it's raising interest rates. It's already stopped its bond purchases a few years ago. We think the European Central Bank is going to follow suit as well. That's already well telegraphed. It's quite surprising that people are quite balled up as well in the room, but you're balled up at a stage when you've already got actually record highs in markets, and markets already popped highs. Valuations on some metrics as well look quite frothy. So the market's very, very polarized. So there's one part of the market that looks very, very cheap, whether you look at it historically versus itself or relative to other assets. And you look at other parts of the market, and it's just expensive on every single metric that you look at. So we are battling with that. A few weeks ago, we had actually one of the largest ever fiscal stimulus coming through the US. This should not be ignored. And surrounding all that, we've got this risk of inflation. So we've been in an environment since probably end of 2013 where actually we haven't really had to worry about inflation for markets. So that's coming back. And for the very, very UK-centric problem is we've got this thing going on, which honestly, we don't know. But we synthesize this down to basically a battle of the two giants. And really, it's money versus the economy. So if you look at the light green line, which is this one going up here, so you've had this situation where global growth, or a proxy for global growth, has picked up. But at the same time, the amount of money growth that's going around the world has actually declined. So you look at this and you go, well, what does this mean? Like, the world's a better place, but there's less money flying around. Should I de-risk? Should I add risk? Should I stay where I am? Should I change portfolio balancing? What we found with our analysis actually is there is enough global growth at the moment to more than compensate for this decline. So actually the guys who were balled up are kind of about right, but don't be too bullish. So what do we do? So how do we take all this information and how do we package it up into a portfolio? And I think the key thing for me is this one down here. It's always being pragmatic and evidence-based. It's really easy to jump onto stories that you see in the Wall Street Journal or the FT, or you hear from other fund managers. But actually, they're really just narratives. What we're trying to do is actually try and find what is the evidence and how should we position for it, and what's our expected return versus expected risk. And so what we do inside all of our portfolios, we always go for best of breed managers. So if we're trying to find someone that's going to give us exposure to UK mid-cap companies, for example, what are we going to do? We're going to find the guys that have shown long-term history, they've worked through different cycles, and they've shown genuine alpha. Fixed income is a really tricky one because actually over the last few years, everybody's been short bonds. You talk to any investment manager or any fund manager in the city, I can maybe name one that's been long bonds, but that's a real exception. But what's happened? They've missed out on a rally, they've missed out on diversification, but most importantly, they've missed out on coupons. You need the income from bonds to generate some form of return. So what we've been doing here has been quite interesting. So we've taken a step back and we said, okay, how do we proxy fixed income, i.e. the cash flows from assets that aren't really equities, but still have this low duration characteristic. So we've had investments in quite an interesting one, which is called a company called Next Solar. And they've got solar panels dotted all across the UK. We know they've got fixed cash flows. Some of them, they even own the assets as well. So we're earning, I think, about somewhere between 6 to 8% a year just off the cash flows off these solar panels. So we add that into the portfolio. When we were talking earlier about the bulls and the bears, well, you're like, actually, there's a situation where you can take both into a portfolio. So we've got a fund called CZ Equity, and these are guys that are called long short. So what they do is they hold some stocks where they actually buy the stocks, and on the other side they short some stocks. And so what happens here is you end up with a nice basket where you have some real exposure which is coming from companies, from company cash flow, but you don't have the directionality with the market. Real return allocations is just a story about when we go back to inflation, about saying, can we put something in the portfolio that's going to keep up with inflation? And geographic and style mix is actually just saying, well, let's have a global portfolio. So there's stuff from Japan, there's stuff from Europe, there's Latin America, all across Asia. And style means we're not wedded to just owning index. There's real specialist stuff behind this. So we recently added to a manager in Europe, a company called Eurocastle, that specializes in Italian loans. So the banking system in Europe about 3 years ago has gone through a step change where it's come out in the woodwork what the actual magnitude of all the bad debt is, and all of that is being cleaned up. So there's opportunities that are opening up there. So that really allows us to access something that most other people aren't. Currency hedging is super important. So if you look at traditional multi-asset portfolios, sometimes it just boils down to a really simple currency bet. Brexit's a good example. If you had anything but sterling in your portfolio, you made money. It wasn't because you were smart about the way you'd put your money to work, it was just luck. It's luck that people voted to leave the EU in the referendum and sterling fell, which meant your assets rose because of a currency effect. So what do we do here? We pay a lot of attention here with currency. So Japan's one where we take a view on where the yen's going to go, and we decide, do we need to hedge the yen exposure, or do we need to keep the yen exposure versus sterling? And derivatives overlay is one where I'll finish up. So this one, I think derivatives have got a bit of a dirty connotation since the financial crisis, but I want to show you an example which is very, very powerful. So we went to our example before. We were going through the slide before about how there's a massive fiscal stimulus coming through in the US. Now, this is big. The magnitude of this should not be underestimated. There should be an impact for US equities for this. So we have a choice, right? What we could do is we could go to market and we could spend $1 million and we can buy exposure worth $1 million in the US equity market. So it goes up 10%, we make $100,000. It goes down 10%, we make $100,000. Lose $100,000, sorry. What if it was worse? What if it went down 50%? We'd lose $500,000. This is the analogy of a kind of a brick falling on this side. Well, actually, there's another way to do implementation. You could buy something called call options. And so what we could do there is it would cost us $100,000 to buy the same exposure. So it's still $1 million of exposure on this side and this side. We still get the upside. So if the market still goes up 10%, we'll still make $100,000 on top of that. But the important thing is our downside is limited over here. So we would only lose what we had paid to buy the call option. So we think more of these type of strategies going into portfolios provide you this cushion should markets fall out of bed. On that note, thank you very much.